Okay, today we are going to look at various tax scenarios on a non-registered account, and I'm going to use federal and provincial taxes combined in the province of Ontario. So this works in all provinces. The rates might be slightly different. Ontario is somewhat of a middle-of-the-road province. It's not the highest taxed province, and it's not the lowest taxed province. So it's somewhere in the middle, so chances are your province isn't that far away from what Ontario is. Okay, so why? There's confusion about the non-registered account in Canada. Non-registered account, open account. Now, first, there's three main accounts in Canada. There's the RSP account and all its derivatives. A pension is a derivative. A RIF is a derivative. A locked-in retirement account is a derivative. All those accounts have a purpose. The purpose is to incentivize Canadians to save for retirement. So that's the first account. The second account is the tax-free savings account. Relatively new account. It's got different tax rules. The RSP and all its derivatives have certain tax rules. The tax-free savings account has certain tax rules. And the third account is the non-registered account. These are the three main accounts. I'm ignoring the registered educational savings plan account or the registered disability savings plan account. I'm ignoring corporate accounts, and I'm ignoring an estate account. So that's it. So the tax rule, what are the tax rules for the non-registered account? And the reason I'm doing this is I had a friend come to me the other day and he said, I just triggered a capital gain. What am I going to owe on that capital gain? And my answer to him was, well, it depends. And he didn't really like that answer. So I kind of want to get into these situations and show what it depends on. So let's go. Actually, let me say this. There's four potential taxable events in a non-registered account. There's a capital gain, there is interest or dividends, there is Canadian dividends, and there is interest expense. So this would be borrowing to invest. So, triggering a capital gain, dividends, interest, and then interest expense. Here I have various income levels. So 50,000, 100,000, 150,000, 220,000 of income. So in this capital gain example, what happens if I sell something that has a capital gain of $50,000? I could have bought something for $20,000 and sold it for $70,000. There's a $50,000 capital gain. Or I could have bought something for $1 million and sold it for $1,050,000. There's a $50,000 capital gain. Let's go through. I'm going to go through the lowest income and the highest income, and probably all four. Okay, let's say I earn $50,000. That's my salary, $50,000, and I trigger a capital gain of $50,000. Well, the taxable portion of that capital gain is $25,000. That's a feature of capital gains. That's capital gains receive preferential tax treatment. This is the preferential tax treatment. Only half the capital gain is included in income. $50,000 plus half the capital gain equals $75,000. Tax on $75,000 is $15,070. I'm going to show you how I got that. I went to the tax calculator. Okay, $75,000 taxable income, hit calculate. In Ontario, you owe $15,070 of tax. That's how I got that number. Okay, tax on employment is $7,657. If I plug $50,000 into that calculator, I get $7,657 of tax owed. That's the situation if I didn't trigger the capital gain. So I triggered the capital gain, I owe $15,070. Had I not, I would owe $7,657. The cost of triggering that capital gain is $7,413, which is 15%. So $7,413 divided by the $50,000 that I triggered is 15%. So let's look at the top marginal tax bracket. In Ontario, the top marginal tax bracket starts at $220,001. So again, here's the scenario. We trigger a capital gain of $50,000. The taxable capital gain is $25,000. That boosts our taxable income to $245,000. Tax on $245,000 is $92,408. If I didn't trigger the capital gain, the tax on my $220,000 of employment income would have been $79,026. The cost of triggering that capital gain is $13,382. $13,382 over $50,000 is 27%. Okay, if I didn't trigger the capital gain and my boss walked in and said, hey, we're giving you a raise to boost your salary by $50,000, well, I'm in the top marginal tax bracket here. And let me go to this. Top marginal tax bracket in Ontario, combined federal and provincial income tax rates 2021. Top bracket is $220,000 and up is taxed at 53.53. So any income above $220,000 is taxed at 53.53. I paid $27 on that capital gain. If it was employment income, that would have been 53.53. Capital gains receive preferential tax treatment. Here's how it works. You trigger the capital gain, half of the capital gain gets added to income, then you just work on the tax there. Okay, interest and dividends from foreign corporations. They're both treated the same, and there's nothing special to these. There is no preferential tax treatment. So I earn $50,000. I get $50,000 of interest or dividends from a foreign corporation. My taxable income is $100,000. Tax on $100,000 in Ontario is $23,454. So that, just to be clear, that is tax paid to the federal government and to the provincial government, and combined it comes to $23,454. There's no tax break here. Tax from the foreign div is 31.6%. That's the same as it would be for employment income. If my boss said, hey, you don't earn 50 anymore, you earn 100, that is what my tax bill would be. It's easier to see this here. $220,000, $50,000 of interest is my taxable income is $270,000. My tax bill is $106,000. And the tax from the foreign dividend or interest is 53.5%, the same as the marginal tax rate. There is no tax difference or break on interest or dividends from foreign corporations in a non-registered account. Okay, dividends from Canadian corporations. There's a funny process with dividends from Canadian corporations. So scenario one, my employment income is $50,000. I get dividends from Canadian corporations that add up to $50,000. I have to gross this up. This is part of the process with Canadian dividends. I gross it up by 138%. So I take this and multiply it by 1.38 to get 69,000. That is a prescribed number that's set by the government. There is a reason for this, and I won't get into the reason, but there is some logic behind this, because it does seem kind of strange why we have to do this. Okay, so my taxable income is $119,000. So that sounds bad. I had $50,000 of employment income, and I received $50,000 worth of dividends from Canadian corporations. How is my taxable income above $100,000? It sounds like it would be very bad to hold dividends within a non-registered account. Well, we also get this, the tax credit of $17,265. That is, there's the tax credit rate, multiply that by the dividend, that gives you the tax credit. Okay, so how this works. Taxable income, $119,000. Tax on $119,000 is $31,702. We then apply the credit. So $31,702 minus $17,265 equals $14,437. That's what we pay. Tax on employment income would have been $7,657, and therefore tax on the dividend is $6,780. So $6,780 divided by $50,000 worth of dividend is an effective tax rate of 13.56%. Dividends from Canadian corporations in the end receive preferential tax treatment. So let's get to the top marginal tax bracket. $220,000, I receive $50,000 of Canadian dividends. I gross it up to $69,000. My taxable income is $289,000. Tax on $289,000 is $115,961. I apply the credit, and that lowers my tax bill to $98,696. Tax on $220,000 employment income or interest income or rental income, just income, is $79,026. So therefore the tax from the Canadian dividends is $19,670. $19,670 divided by $50,000 of dividend is 39.34%. Okay, so this is lower than 53.53. So you can see the effect of the preferential tax treatment on Canadian dividends. It's easiest to see it in the highest tax bracket, because in these brackets, you know, you're in a tax bracket here. When you add 50 or 69,000 to this, you're moving through 3 or 4 tax brackets. Here you're in the top, so you're not moving through any more tax brackets. So those are the 3 big scenarios: capital gains, interest and dividends from foreign corporations, and Canadian dividends. Ultimately, of the 3 accounts, this is likely the least attractive account to invest in. However, it's often necessary to invest in an account, in a non-registered account. Your RSP might be full, or you might have enough in it that you don't want to add to it, or you may be riffing, you can't add to a riff. Your tax-free savings is full, so you have no choice but to use the non-registered account. And if that's the case, you have to look at things like this. Do you really want to be holding interest income or dividends from foreign corporations in your non-registered account? If your non-registered account, if you're really wealthy, there's no getting around it. You couldn't skew everything towards capital gains and Canadian dividends. And the wealthier you are, chances are the bigger your non-registered account, because there's limits on the tax-free savings and there's limits on the RSP. So it will eventually flow into the non-registered account. So that's it. You have to kind of look at these things. So back to what I was saying. So my friend asks me, how much do I pay on my capital gain? It depends. The taxable capital gain is added to what level of income. If it's $50,000, you pay a certain amount. If it's zero, you pay a certain amount. You know, anything in between. If it's over the top marginal tax bracket, if it's over $220,000, you know you're paying 27%. So let's look at the final scenario. Interest expense. So the scenario here is we borrow $50,000 at 10%. At an income of $50,000, we borrow at 10%. So our interest expense is $5,000. How that works is it lowers taxable income by $5,000. Tax on $45,000 is $6,402. Tax on $50,000 would be $7,657. The after-tax cost is $3,745. We reduce our tax bill by $1,255 by having $5,000 of interest expense. So that's how borrowing to invest works in a non-registered account. This doesn't work in an RSP, even though you can borrow to invest in an RSP. You don't get this reduction of interest expense. So in this scenario, the after-tax rate to invest is not 10 anymore, it's 7.49. In the top marginal tax bracket, we still borrow the same $50,000 at 10%. We still have the same $5,000 worth of interest expense. That reduces our taxable income from $220 down to $215. Tax on $215,000 is $76,483, and it would have been $79,026 if we just didn't have the interest expense. We reduced our tax bill by $2,543. The after-tax cost to borrow $50,000 at 10% in the top marginal tax bracket is $2,457 for an after-tax interest rate of 4.91%. So you can see that as income rises, the benefit of tax deductible interest expense rises. So anyway, that's it. So, if somebody says, I got a Canadian dividend, what am I going to pay in tax? I got $1,000 of Canadian dividend. What is my tax bill going to be? The correct answer is, well, it depends. It depends what you're adding that grossed up amount to. Are you adding it to $50,000? Are you adding it to $100,000? Are you adding it to $220,000? Or anything in between and above? Anyway, thank you for watching. A lot of numbers there. Hope you enjoyed my spreadsheet.